The trading day is alive and well. We have seen some weakness on both sides of the border, but there is a case to be made for TSX outperformance. We talked earlier with Paige Ellis about the fact that yesterday Canadian equities weakened less than their U.S. counterparts. And our next guest sees a potential outperformance for the Canadian market in 2023. Gargi Chaudhuri is head of iShares Investment Strategy Americas at BlackRock and joins us now. Nice to have you with us. And let's just talk about it. Maybe we can walk through the start of 2023. Started with some optimism. That's starting to cool down. Does that surprise you at all?
Good morning, John. It's great to be here. Thank you for having me. And you're right, absolutely. It's been an amazing start to the year. And I think that's a little well-deserved given the performance of global markets, both stocks and bonds last year. And I think now investors are sort of coming to terms with the fact that we have a few hurdles to get through. Obviously, the earnings season is upon us. I was listening to the show earlier and you were talking about that. And we have to contend with the fact that there are going to be earnings downgrades to contend with for the remainder of 2023. So that's one. I'd also say that I think we as investors have been a little too bullish what might happen from central banks. I think much of the rate hikes are over, but still both the Bank of Canada as well as the Fed is still hiking rates. And that I think will mean that we can have some of the volatility that we've seen in the market continue into this year as well. So I'll still say that Canadians are in a really good position. I talk about that in our iShares year ahead guide in terms of the market outperforming the US markets, just given the composition and the weight towards energy, which is a sector that we're very positive on.
And I mentioned off the top your view that it would not be a surprise to see outperformance by, let's say, the Canadian market because of that composition in 2023?
Yes, absolutely. So I think two things to think about here. It's obviously the composition, the weight of energies, which we think will still over the medium term to long term continue to outperform given the shortages, given, of course, the China reopening that's very much front and center of investors' minds. But there's also the underweight to tech. And I think that's important in a world where interest rates are likely to stay higher for longer. It obviously doesn't bode as well for growth sectors of the market that have relied historically upon negative real rates to have this PE expansion. And I think that world is at least for the next 6 to 12 months not really returning. So it's the underweight to tech, it's the overweight to financial energy sectors that we actually like. And looking at something like an XEI or an XEG, which are Canadian tickers that give you those high dividend paying, very high quality energy sector exposure in dividend paying names or just energy outright makes a lot of sense.
Higher rates for longer, does that mean we should also get used to the idea of inflation staying at elevated levels? I think what was kind of interesting as we saw signs of inflation easing in various data points on both sides of the border, let's say sort of over the last couple of weeks, investors all of a sudden felt okay talking about disinflation, which they very much were avoiding last year. But would it be your view that inflation story or prices getting back to those levels that central banks are comfortable with is going to be easier said than done?
That's the most important question, I think, of the year, certainly of the day. And to your point, we saw the CPI report, both sides of North America. And I think there has been a huge amount of optimism around the gradual decline in Canada, obviously coming down from that 8.1% to sort of looking at those trimmed numbers in the fives, which is definitely a positive sign. And in the US, the same thing. We're sort of sitting at 5.7 core inflation, which is a far cry from what we had seen earlier last year. However, I think that 8 to 5 or 9 to 5 in the case of US was the so-called easy move. I think we have to brace ourselves for a world where we're not going to get back to the pre-pandemic 2% or sub 2% level. So the easy move has happened, but now what we're seeing in the data is that certain components of inflation, shelter inflation particularly, services inflation more broadly, does remain sticky. And I think we need to see that move meaningfully lower for for us to have any kind of confidence that inflation is going to quickly jump back to that 2% level. And we are just not seeing that. So for right now, I think it's fair to say that inflation will certainly continue to move lower. We're not going to stick at 5% or thereabouts. But is it 2? No, we think it's more likely somewhere closer to a 3. And I think, bringing back my earlier point, that means that rates are higher for longer, which is actually really good. I think I've never been as giddy as I've been about the opportunities in fixed income markets. If you're an investor looking at something like an XFR, which gives you sort of floating rate exposure in the front end of the curve, earning close to about 4.9%, that's incredible opportunity, especially given where we've been in the last sort of 15 years.
You're going to be that rare breed skipping down the street with higher interest rates, but that's because you've got your investing hat on. And beyond that, we didn't talk about financials, but we highlighted your view on fixed income, and we highlighted your view on energy. But as a category, financials, which by the way, they do tend to benefit from those higher interest rates, assuming we don't see a worst case scenario for the economy.
Absolutely. And again, when we think about this worst case scenario for the economy, look, I think it's very fair to expect a little bit of a slowdown from the Q4 GDP levels. And I think, at least in the US, and this is a US specific comment, we might even see some negative GDP prints in the second or third quarter. But is this going to be that protracted recession that we had seen perhaps in the financial crisis? The signs don't point to that yet. I think in this higher rate environment that we're going to stay in both the US and Canada, I think that can do very well for net interest margins. And I think financials, again, can do better. And like we mentioned earlier, this idea of value trading better than growth is something that we're very focused on for the next 6 months or so, till we really start to believe or hear from the Fed or the Bank of Canada that they're willing to cut rates meaningfully. And there's no sign of that in a higher inflationary world.
All right. Great.